Hi guys, today I'm gonna talk about market phases. So I'm gonna keep it very simple. So first we are gonna start with the explaining what are the market phases and what are the reasons that they are occurring at the daily basis. So I marked all market ranges and the breaks so you can see how they form. Then I'm just gonna open these blue boxes are the expansion phases. So expansion phases are the phases that market is expanding to the one direction, and it's just creating a move that moves the price from point A to point B. Okay, this is a reason how market gets the liquidity from higher time frames. Okay, as you see, each market phase, each expansion phase breaks the structure. If it's not breaking the structure, it's not the expansion phase. We're going to talk about it later. So as you see, when each expansion phase occurs, like this one, it breaks the structure. So it's confirmed that it was actually the expansion phases. It gets the higher time frame liquidity. So what happens afterwards? Afterwards, price expands for a while. It starts to retrace into the range. It starts to into the range, and what usually happens is that when price tries to retrace into the range, what happens is that price usually tries to mitigate the order blocks like this one, mitigate the order block, or try to fill the gap which is inside of the range. So for example, there is an expansion phase, and what happens that when expansion phase finishes, price starts to retrace and tries to fill this inefficiency here. Okay, when price expands, then what happens is that price tries to fill this fair value gap or mitigate at this order block. Okay, so price comes into here. So in this case, it does not continue to expansion phase. It does not finish the retracement phase and start new expansion phase. What happens is that it just breaks the structure. So the blue boxes that I mark up are the reversal phases, and reversal phases are just the expansion phases which is to the other direction, which is to the against to the first expansion phase. So but this is only confirmed after we break the structure to the other direction, not the continuation. As you see, these four market structure ranges were the continuation of each other's. Each market phase, each expansion phase break the structure to the lower. But in this orange boxes, as you see, is price breaking to the other side, to the other direction. So this is the reversal phases. So in the daily life, I'm not looking at them at things like the reversal phases, because when it breaks there, I know that we are expansion phases to the other direction. So it's just the expansion phase. We call it reversal to differentiate between expansion and reversing situations, but just an expansion phase to the other direction. So when we break the structure here, now we get another, actually this would be the reversal phase to this market structure as well. This is just an expansion phase to the other direction. What happens is price tries to mitigate here. What happens that when we create this expansion phase, price comes to mitigate this order block and fill the resting liquidity in this fair value gap. Okay, then what happens is that price tries to start a new move. It fails here. We are going to talk about the failing situation in the ranging market phase. So what happens that price creates new expansion phase, it breaks the structure, tries to come back to fill some liquidity. It might be at the lower time frame, let's say in the 4-hour chart. Now it creates a move to the downside. It comes back and tries to fill the fair value gap a little bit, then creates another move, expansion phase. Now it comes and tries to mitigate this order block. So it creates a move to other direction, comes and tries to mitigate this order block, creates this move, breaks the structure. But as you see, we have an immediate candle which breaks to the other direction, which is the reversal phase of this market structure range. And afterwards, what happens that price comes back. Price doesn't continue closing below and below. It just comes back, tries to mitigate this order block, mitigates done. Then after this retracement phase, so don't forget that retracement phases for mitigation and filling the resting liquidities, okay, which are in form of maybe all high and old low, or maybe as a fair value gap like this one. Okay, like this example. Why it's not drawing? Okay, like this example. Okay, so yes, price mitigated here, then created new expansion phase to the lower. This expansion phase might be like this one. Okay, then what happens that price starts the retracement phase, mitigate an order block, probably a lower time frame order block right here, then goes back to the lower. So what happens that when price is not able to break one direction or another? When this happens, we call this a ranging market condition. So what happens is that price respect to the thing, to the low of the market structure and high of the market structure. Okay, price respect to the range of the market structure. Low of the market structure will be protected in terms of not be broken, and high will be protected in terms of not be broken. It could be taken like a rate, but it will not be broken. So in this type of scenarios, that when we have a ranging market condition, what I do is I mark the 50% of it, and above the 50% it will be premium, and below the 50% it will be discount. So I'm gonna look for long opportunities as a daily confluences. I'm gonna look for long opportunities below the 50% of the range, and I'm gonna look for shorting opportunities above the 50%. So this equilibrium will work the separator for premium and discount zones. Okay, after that, how you can just understand that it is a ranging market. So you're gonna look at like this. When we have this expansion phase, and when we started to the retracement phase, what we expect from the price to do? Price needs to take all liquidity or mitigate or fill some gaps, then continue for new expansion phase. As you see, this is the last order block after this fair value gap filled. It filled, but price didn't hold it, didn't respect it to do this order block. It made a small move, but didn't respect it totally to break the structure. So what happens that price breaks this order block, takes this high. That's okay, we can roll down from here. But when price tries to roll down, we create a failure swing. Okay, we create a swing low without breaking the market structure. And after this candle close, we will get a confirmed swing low. So we understand that price is not willing to break the structure. So now we justify that this is a market structure. This is a market phase that is ranging currently. You can make this argument at here as well, but when the raid and the swing low at the same candle, like a outside candle in this candle, I don't like to use this one. I would like to use this one. Okay, I would just be careful along this move. So let's see, do we have another ranging condition? Yeah, as you see, price makes a move, expansion phase, then tries to retrace, then fails to break higher. It has to continue, it creates the move. So in this candle, okay, in this day, I would look at this ranging market, and I would mark the 50% of it and try to short above it and long below it as a daily confluence. As you know, I'm not looking for one candle confluence. So in terms of like in this day, we have daily confluence of being at the premium, but it's not enough for me to short it. Okay, it has to give me something at the lower time frame as well. Confluence has to stack together, stack on top of each other. Then I will get the trade. So yes, it's basically like this. You can understand that we started to ranging market conditions from a failure swing inside the market structure levels, and also you can just simply see that after the expansion phase we need a retracement phase to fill the resting liquidity and mitigate the order block, or it could be a breaker or something else. Then you would expect another expansion phase for market to continue. If it's not continuing and it's creating like failure lows, failure swings like this, it is a ranging market. if it breaks the structure, it was an expansion phase. If it breaks to the higher, to the other direction, it's a reversal phase. But after it breaks, you can understand that it is a new expansion phase, so you can go along with it. And then if you get another swing high, let's say, you will understand that this was a reversal phase, but now it's finished. Now we are coming back to the retracement phase, and we are gonna try to mitigate new order block. Then we expect to continue from there, etc., etc. Okay. So after this, how you understand the retracement phase finishes is that, let's say, when we come into this fair value gap in lower time frame, we can look for a market structure break. We can look for rate in the lower time frame, and these kind of confluences will say that this daily retracement phase might finish like this, or you can simply wait for the daily to create or form swing highs like this one, then continue to lower, and you can find the confluences like that as well. Or else, what could you do is, when you have a market structure rate like this, you could understand that, oh, now price is rejecting to the going that direction, because this is the direction that we don't want the price to go in terms of continue the direction of the market structure. So when this rate close happens, you can understand that, oh, now the retracement phase is finished. Now we expected expansion phase. If it doesn't give the expansion phase as we're willing to do, like this one, we understand that it's a ranging condition, so we are gonna trade according to that. Okay, see you guys.